Warren Buffett has never kept an emergency fund. Neither has any billionaire in history. Yet financial advisors tell ordinary people to keep 6 months of expenses in cash, while the wealthy use debt to multiply their wealth faster than inflation can destroy it. This isn't hypocrisy. It's evidence that rich people and poor people are playing completely different monetary games. And the game poor people are taught to play guarantees they lose wealth over time, while the game rich people play guarantees they accumulate wealth over time. Most people believe saving money is the safe, responsible choice. But in our current monetary system, saving money is actually the riskiest strategy possible. You're gambling that the purchasing power of your currency will remain stable, while every economic incentive in the system works against you. Here's what I mean. When you save $10,000 in a bank account, you think you have $10,000, but you don't have $10,000. You have a promise from the bank that they'll give you $10,000 worth of currency when you ask for it. The question is, $10,000 worth of what? If inflation runs at 3% annually, your $10,000 becomes $9,700 in real purchasing power after 1 year. After 10 years, it becomes $7,400. After 20 years, it becomes $5,500. You didn't lose any nominal dollars, but you lost nearly half your wealth. The bank kept their promise to give you $10,000 in currency, but that currency buys half as much as it did when you saved it. This isn't a theoretical problem. This is mathematical certainty. Central banks explicitly target 2 to 3% inflation annually. They announce this policy publicly. They're telling you directly that they plan to reduce the purchasing power of your savings by design, yet financial advisors still recommend holding cash as a safety strategy. Now, let's look at how wealthy people approach this same problem. When a rich person needs liquidity, they don't save cash. They get a line of credit secured by their assets. Let's say they own $1 million worth of stocks or real estate. They can borrow $500,000 against those assets at 4% interest. They pay interest only on what they use and only when they use it. Meanwhile, their assets continue appreciating. If their stocks return 8% annually, they're earning 8% on $1 million while paying 4% on whatever they borrow. They're making money on the spread. Plus, the interest they pay is often tax deductible, while the gains on their assets are often tax advantaged. But here's the key difference. When inflation hits 3%, their debt becomes cheaper in real terms, while their assets appreciate in nominal terms. Inflation helps them by making their debt worth less while making their assets worth more. They're using the same inflationary pressure that destroys cash savings to accelerate their wealth building. The psychological difference is profound. Poor people save cash because they fear debt. Rich people use debt because they understand it. Poor people see debt as dangerous. Rich people see debt as a tool. Poor people optimize for safety. Rich people optimize for opportunity. This creates a systematic transfer of wealth from savers to borrowers. And while you're holding cash that loses purchasing power, borrowed money is being invested in assets that gain purchasing power. The monetary system rewards risk-taking and punishes safety-seeking. The banking system amplifies this transfer. When you deposit money in a savings account, the bank doesn't just hold your cash in a vault. They lend that money to other people at higher interest rates. You might earn 0.5% on your savings, while the bank lends your money at 6% for a mortgage or 18% on a credit card. Your savings become the capital that funds other people's wealth building. The careful, responsible saver provides the money that the aggressive, leveraged investor uses to buy real estate or start businesses. The saver gets nominal returns while taking inflation risk. The borrower gets real assets while the currency depreciates. This is why every financial crisis follows the same pattern. The people who saved cash for decades lose purchasing power to inflation and currency devaluation. The people who borrowed money to buy real assets see their debt inflated away while their assets appreciate. The responsible get punished, the leveraged get rewarded. The 2008 financial crisis demonstrated this perfectly. People who saved cash and avoided debt watched their purchasing power decline as central banks printed trillions of new dollars. People who bought real estate with maximum leverage saw their debt become cheaper while their properties eventually recovered and exceeded previous values. The wealthy understand this cycle because they study monetary history. Every fiat currency in history has eventually been devalued through inflation or collapse. The dollar has lost 96% of its purchasing power since the Federal Reserve was created in 1913. The pattern is consistent. Governments print money to fund spending. Currency loses value. Savers lose wealth. Asset owners gain wealth. But most people don't study monetary history. They trust the advice they're given about saving money being safe. They're taught to fear debt and avoid risk. This conditioning serves the system perfectly because it creates a reliable source of capital from people who will accept below-market returns in exchange for the illusion of safety. The advice to save money made sense when money was backed by gold or silver. Physical money couldn't be printed arbitrarily. Saving actual money meant accumulating actual wealth. But in a fiat monetary system where money is created from nothing by central banks, saving money means accumulating IOUs that lose value by design. Young people especially get trapped by this advice. They're told to save for 20 or 30 years before they can afford to invest or buy assets. By the time they've saved enough cash to make a down payment on a house, the house costs twice as much as when they started saving. They're running on a treadmill that moves faster than they can run. Meanwhile, people who borrowed money to buy assets 20 years ago have seen those assets appreciate while their debt became cheaper. The person who saved diligently for a house down payment gets outbid by someone who already owns property and can borrow against it. The saver's discipline becomes a disadvantage in an inflationary system. This is why wealth inequality accelerates during inflationary periods. Asset owners get richer as their holdings appreciate in nominal terms, and their debts become cheaper in real terms. Cash savers get poorer as their purchasing power declines. The gap between borrowers and savers widens systematically. The psychological impact compounds the financial impact. As savers watch their purchasing power decline, they often save more aggressively, thinking they need larger cash cushions. This makes the problem worse. More cash means more inflation risk. The solution they choose accelerates the problem they're trying to solve. Financial advisors rarely explain this dynamic because it challenges their entire business model. They sell safety and security to people who are afraid of risk. If they explained that saving cash guarantees real losses over time, their clients might start questioning other conventional advice about avoiding debt and deferring investments. The education system reinforces this conditioning because it teaches people to follow rules and seek approval from authority figures. The same mindset that makes someone a good employee makes them a bad wealth builder. They wait for permission to take risks, seek safety and conventional advice, and trust experts who are incentivized to keep them dependent on the system. This creates a perfect trap. The people who most need to build wealth are the ones most likely to follow advice that prevents wealth building. They save cash while others buy assets. They avoid debt while others use leverage. They seek safety while others capture opportunity. The gap between rich and poor isn't about talent or effort. It's about understanding how money actually works. The irony is that saving money feels responsible, while building wealth feels reckless. But in an inflationary monetary system, the responsible approach guarantees poverty, while the reckless approach builds wealth. The system inverts normal risk perception to benefit people who understand the inversion. Warren Buffett doesn't keep an emergency fund because he understands that holding depreciating currency is the emergency. His wealth is in appreciating assets that can be leveraged for liquidity when needed. He's not gambling with his future by avoiding cash. He's protecting his future by avoiding the systematic wealth destruction that cash savings guarantee. The choice isn't between safe and risky. The choice is between visible risk and invisible risk. Saving cash feels safe because you can see the nominal amount in your account, but the invisible risk of purchasing power loss is mathematically certain. Buying assets feels risky because prices fluctuate, but the invisible safety of real wealth accumulation protects against the monetary system's built-in wealth destruction. Most people will continue saving cash because they've been taught that it's responsible. They'll watch their purchasing power decline slowly and steadily, wondering why they can't get ahead, despite doing everything right. They're doing everything right for a monetary system that no longer exists. They're playing by rules that were written to create employees, not wealth. The people who understand how modern money works will continue using debt and leverage to build wealth while others subsidize their success through cash savings. This isn't a conspiracy, it's simply the logical result of different approaches to the same monetary system. One approach works with the system's incentives, the other works against them. Understanding this doesn't require complex strategies or sophisticated investments. It requires recognizing that the advice you've been given about money was designed for a different monetary system and a different economic reality. In today's system, the most dangerous financial advice sounds like the safest.